Math is a wonderful thing. It's everywhere in our world. But what's even better about math is that it can help us make more money. Now, in investing, there's tons of math, and I'm going to show you how we can use math to determine how much we should be investing, where we should be investing, and how exactly our money can grow with investing. To create a hypothetical scenario in which I'm going to talk about investing, I've taken the median Canadian household income, which is $74,454, and I'll be using that within my project to make the decisions. There are two reasons why people choose to invest. The first being they want to save their money, and the second being they want to grow their money. Now, for new investors, it's usually the case where they want to save their money more than they want to make money because they don't want to take on too much risk. So with my hypothetical income, we're gonna stay true to that and stay more conservative and try to save our money rather than grow our money. Now, with that budget we've set for investments, there are a number of different types of investments we can make. There's mutual funds, there's stocks, there's bonds, there's real estate. The list literally goes on forever. But for the purpose of this project, we're going to focus on the three main types of assets, which are stocks, bonds, and cash equivalents. When you have those three assets or more as investments, that it starts to become a portfolio. Now, the key to having a good portfolio is diversity, so that when, say, you have stocks and they start to struggle, you have bonds that'll help keep your income stable so that you'll always be making money. And as for portfolio types, there are two. You could have a conservative portfolio or an aggressive. An aggressive will generate higher yields but at a much higher risk, whereas conservative is lower yields but with minimal risk, and it's about more about saving your money, which is what our hypothetical is looking to do. So if we were to follow this conservative portfolio, it would look something along the lines of 70 to 75% fixed income securities, or otherwise known as bonds, 15 to 20% equities, which is stocks, and then 5 to 15% cash and equivalences, which is savings accounts, treasury bills, and other types of things like that. The first asset we're going to look at is a fixed income security, otherwise known as a bond. What this is it's when an investor will loan out his money to either a company, a government, or any other type of entity, and in return he will get a fixed interest rate, which will be paid annually. Now these bonds can last a number of years. Usually it's 10, and the interest rate will be paid annually for the whole 10 years, and then at the 10 years they will be given their initial investment back. So in total they will have earned the interest rate going through 10 years plus their initial investment, which is just the definition of what a safety investment would be. That is why in our conservative portfolio, it is bonds will take up 70 to 75% of our investments. Now this is where the math will come in with bonds, and it's when you're trying to calculate for the return that you will receive when purchasing the bond. So there's a formula that describes this relationship between the return and the rate and the time, as well as the initial investment. So we have this formula, and once we plug in all the variables, we'll be able to determine our return. Now the return is just the money received from the interest rate, not including the initial investment, which you will receive back when purchasing a bond. Now bonds are linear functions, even though the equation is set up as a simple interest, much similar to a compound interest, but since it's not compounded, it will not be an exponential function, it'll be just a linear function. We're now moving on to equities. Now an equity or stock, it represents a share in the ownership of a company. Now when you're holding stock, you have a claim to everything that a company owns, but most importantly, you have a claim to assets and earnings, which is what gives value to a share. So when you buy a share at a certain price, you're buying a piece of someone's company. So when that company earns money, you get a piece of that money. To give an example of what it's like to buy shares and how it goes through, let's say we have a company valued at $11 million. Now its annual profits is $1 million, and in order to raise money, the company will sell shares. So it'll sell 440,000 shares at $25 a share. Now when you multiply 440,000 by the $25 a share, you will get the $11 million evaluation. Now if you buy one share, you will be entitled to $2.72 of the profits of that company. Now the math done to get that number was the $1 million profit divided by the number of shares, which is 440,000, and that will equal to the earnings per share. Now if you were to own more shares in the company, you would be receiving $2.72 per share you have. Now companies do not always pay these dividends to you. Sometimes they will be used to grow their company. So the board of directors will decide whether they pay the dividends to their shareholders or to use that money to grow the company. If you own stock and the company decides not to pay dividends, there's one other way where you can make money off the stock. Now that way is based solely on the increase in the share price. So if you buy a stock at $10 a share and you hold that stock for an amount of time, let's say 3 years. Now once that 3 years has passed, the stock now sells at a price of $30 a share, and you decide to sell your shares at that price. You will make the that much of a gain. So if you buy them at 10 and sell them at 30, that's an extra $20 per share that you're making off of the shares you originally purchased at 10. So that's another way to make money off of your stock. Now stock prices will go up and down randomly. It's almost impossible to predict what a stock price is going to be. But if you look at a graph of the stock prices over a certain amount of time, it'll go up and down and up and down. But if you draw a best fit line through the graph, you will be able to see if the stock is actually increasing over time, decreasing over time, staying around the same. So by this best fit line, you're going to be able to not predict, but foresee the direction in which the stock prices are going. So if the best fit line is going up, then you can assume that for at least for the short while, then the stock prices will rise. Even if it's going down and up and down and up, it'll still over time go up. Now the final asset is cash and equivalents. The main type of investment we have in this category is treasury bills. Now this is extremely straightforward. The math is incredibly simple. It's similar to a bond in the way that you will pay for it's a loan that you're giving out, except for that you'll pay, instead of face value, you'll pay at a discount, and then after the certain amount of time that the bill is good for, so the maturity date, at the end of the maturity date, which is usually for treasury bills very short, probably around a 3-month period, you will be paid at face value when you originally paid for it at a discount. So over 3 months you could have paid for it at $9,800, but then at the end of the maturity date you will be paid the full $10,000. So you will have made $200 in that 3-month period, and that is what a treasury bill is. Now in this category there's also savings accounts, which are exponential functions. So you'll put your investment in a savings account with an interest rate of 3%, and that could be compounded annually. So what an exponential function does is it goes up or either down at an exponential rate. So if you have it compounded annually, you will have the 3% added to your original investment at the end of the year, and then at the end of the following year you will have another 3% added to your original investment plus the first 3%. So it just keeps adding and adding like that, and that's how it ends up being an exponential function. And yeah, those are the three main assets we looked at and the math behind them, and how they can really help us understand how to make better investments and how we can watch our money grow.